Hello, and welcome to Week 3, Introduction to Deductions. By the end of this lesson, students should be able to describe the use of the standard and itemized deductions, and identify tax reduction techniques through other types of expenses. As we learned in a previous week, there are two general types of categories of deductions, above-the-line deductions and below-the-line deductions. In this lecture, we're going to focus on some of those above-the-line deductions in more detail. Now, here's a refresher. Again, we've already covered in a previous week the major types of above-the-line deductions, but just as a reminder, those include trade or business expenses, health savings account deductions, traditional IRA contributions, early withdrawal penalties, educator expenses, student loan interest, and certain alimony paid. Now, some of these deductions are pretty self-explanatory, but I'd like to talk in a little bit more detail about a few deductions. And the first of those is the health savings account, also known as HSA. So the most important thing to know about making HSA contributions is that you must have qualifying high deductible health insurance in order to make an HSA contribution. It has to be your only form of health insurance, so you can't be covered also by a spouse's plan, you can't have a secondary plan, and you cannot be enrolled in Medicare. If you meet those requirements and you have just one health plan and it's a qualifying high deductible health plan, then you're allowed to make a contribution up to a certain limit, and that limit changes every year, so refer back to your textbook for the most current deduction limits. One of the nice things about a health savings account contribution is that it is not limited by your income. So you could have $10 million in AGI, you could still make that health savings account deduction provided you have the qualifying insurance. A couple of other nice features of HSAs include the ability to use that money in a future year. So if you are familiar with a flexible spending account or maybe a dependent care account through a job that you've had in the past or maybe you currently have, those are considered use it or lose it plans. So you have to think you have to be conservative, you have to plan your budget for the year, and most people don't plan on getting sick. But if you know you go to the optometrist once a year, you know that you buy contact lenses, those types of things, you can budget that amount in your FSA account. And as long as you take the money out by a certain period of time, then everything's fine. But if for whatever reason you don't use all the money in that account, then it's lost to you. With a health savings account, you don't have to worry about that budgeting. If you have the ability to make that full contribution, you can go ahead and do it. And if you don't use it all in a given year, then you can carry it over to the next year and the next year and the next year. Furthermore, you can make a contribution, and even if you have those qualifying expenses, you are not required to seek reimbursement. So it is possible that you or a client may set up a HSA, make that maximum qualifying contribution, and just keep receipts for those qualifying expenses, put them in a file, and years down the road, if there's a need for some cash or a need for some funds to fund a different goal, as long as your expenses were incurred after that HSA was opened, you can reimburse yourself for those expenses at any time in the future. The final nice thing about an HSA is that if you invest your money and you are lucky and don't have a lot of qualifying health expenses pre-retirement, when you reach age 65, if you have taken distributions for all of those medical expenses you can be reimbursed for, you can take additional distributions that have nothing to do with qualifying expenses. You're not subject to a penalty. That money is subject to income tax, and so it works in effect like a deductible IRA or a qualified retirement plan. So you may find some clients who have the right insurance and have the ability to save those extra dollars will find it very handy to make those contributions and use that as another retirement savings vehicle. So HSAs are a great way, a great tool in the toolkit, both to fund health expenses and manage cash flow during the working years and potentially as a supplement in retirement. So next we'll talk about individual retirement accounts. So there are several types of individual retirement accounts. These accounts are separate and apart from what we are calling qualified plans. Qualified plans are offered through a business. Individual retirement accounts, in contrast, can be opened by any individual, and the only requirement to make a contribution to an IRA is that you have earned income. So your contribution to an IRA is limited to the lesser of 100% of your compensation or a statutory limit that is indexed for inflation. So again, refer to your textbook for the limit for the current year. In addition, there is a catch-up contribution, much like for qualified plans. There's a separate limit for individuals who are 50 years and older. Now, there are further restrictions in a taxpayer's ability to deduct an IRA contribution. If the taxpayer is not a participant in a qualified plan, then it doesn't matter what your income from all sources is. As long as you've got that compensation to fund the IRA contribution, it is a deduction for you on page 1 of the tax return. If you or your spouse are participants in a qualified plan, then the deduction is subject to certain limits. You may still be able to make the contribution, it just may not be deductible. And then the final thing I'll say about participation, in the context of being able to make IRA contributions, you are considered a participant in a plan if you are eligible to participate. So it doesn't matter if you decline to participate, it doesn't matter if you don't defer, it doesn't matter if you don't get any employer contributions. If you work for a company that offers a plan in which you are eligible to participate, you are considered a participant for this definition, regardless of whether you participate or not. So that's an important thing to keep in mind. Now, I mentioned that anybody really with compensation, with earned income, can make IRA contributions. Some people can deduct them, others cannot. If you are in the boat of not being able to deduct your contribution, then you've got two options here, either the non-deductible IRA or the Roth IRA. So the front end and the middle are similar for non-deductible and Roth IRAs. It's just the distribution phase that is treated differently. So for a non-deductible IRA or a Roth IRA, when you make that contribution is non-deductible. You will not see that on page 1 of the tax return, and you don't get a tax benefit for that. Likewise, while the contribution is growing inside the IRA account, those earnings, interest, dividends, realized gains, are tax deferred. So you're not paying taxes on whatever's happening inside the account, which is different from a taxable account where you would be paying income tax on the taxable transactions that occur. So again, the difference comes in the distribution phase. With a non-deductible IRA, you have what is called basis, and a portion, typically a small portion of that distribution that comes out during retirement will be tax-free, but generally most of that is going to be taxable as ordinary income. However, with a Roth IRA, none of that distribution is taxable to you. So with a non-deductible IRA, we say those contributions or that money grows tax deferred. With a Roth IRA, we say it grows tax free. So obviously, if you're not eligible to make a deductible IRA contribution, the Roth IRA is much better than a non-deductible IRA contribution, so why wouldn't everybody choose it, right? Well, of course, there are some income limitations around that. Indexed for inflation, so again, check your textbook for the income limits for the current year, but only certain taxpayers, middle income and lower, are really allowed to make those Roth IRA contributions. Everybody else must make the non-deductible IRA contributions. Very important to understand those differences because, of course, every client would like to make a Roth IRA contribution, but you'll find that many of your clients, especially those who are getting later into their career, they have higher salaries, more income, more disposable cash to fund additional retirement plan vehicles. They will be more likely to be interested. They will be less likely to qualify. So make sure that you research all options when you're making recommendations to your clients with respect to IRA contributions. Now, the last type of deduction, above the line deduction, that we're going to dive into in a little bit more detail today are business expenses. And so this is an individual income tax class. We aren't going to spend a ton of time talking about businesses. However, it is possible for an individual to be a business owner. And if the individual is an S corporation shareholder, a partner in a partnership, or a sole proprietor, that business income and business expenses get reported on the individual income tax return. So some of those most common business deductions, especially the ones that we see on page 1, include retirement plan contributions, and this is what we would call the qualified plan contribution. So this is a business retirement plan, not the plain vanilla IRAs. Also, self-employed people can deduct health insurance on page 1 as opposed to as a medical expense on Schedule A. Now, a couple things to say about health insurance. First of all, you need to be self-employed, so basically you need to have some income where you're paying self-employment tax. That's how you know whether you're self-employed or not. The exception would be a greater than 2% shareholder in an S corporation. They are also considered self-employed for health insurance and fringe benefit purposes. In addition, that health insurance must be either an individual policy or a policy acquired through the business. So you can't be a self-employed person, participate in the health insurance of your spouse who is part of a group plan somewhere else, and be eligible to take that deduction on page 1. It can't be part of a group plan unless the group is for your business. That's a little bit about the health insurance deduction. Those taxpayers who are paying self-employment tax, half of that tax gets deducted on page 1. And the concept here is if you are your own employee, and so if you are paying someone else your self-employment income, you would have to pay half of the self-employment tax on behalf of them for their salary. And so this allows you to do the same thing for yourself. That is on page 1, though. It's a deduction for AGI. And then finally, home office deductions are available to self-employed people. I often get the question, does the home office deduction trigger an audit? Many years ago, the IRS was focusing on home office. They felt there was a lot of abuse there. But I don't find that to be an audit trigger today. However, I do make sure that the client, the taxpayer, does qualify for home office. And the most important 2 points I think to consider to remember for the home office is it is your sole place to do business. So it can't certainly be a secondary place, and it can't be a place where you do most things, but then you go and have a permanent place to meet with clients. That won't work. And then also the home office must be a dedicated space. So it can't be the spare bedroom or the den or the kids' play area where you also have the computer. It needs to be that dedicated space. But if a taxpayer meets those requirements, there's no reason not to take that home office deduction. So this concludes this part of our lesson this week. You have learned 2 general types of deductions and the detail of above the line deductions. And we've also talked about the value of those above the line deductions.